Good evening, everybody. It is Monday, June the 13th, and it's been a day of extreme negativity in the markets, ballooning debt markets, and we will certainly talk about that. So let's get started. I'm your wealth guy. Let's talk money. Let's talk market wrap up. All right, everybody. So let's just jump right into it because we need to talk about the markets, and let's start with the equity side first. The Dow Jones finished 876 points in the red. The S&P 500 finished 151 points in the red, and NASDAQ finished 530 points in the red. TSX 532 in the red. So right across North America, all indices finished in the red. Now, U.S. indices are formally in bear territory. Well, let's have a look at the rest of the market because crude actually had a turnaround midday and is now finished or has finished at 42 cents in the green. The US dollar, did you see it run today? Currently up 103. Incredible run to the upside there. But the big story is that 10-year yield, which I have talked about over and over. And at one point today, the 10-year yield had reached 8.6% to the upside. An incredible and alarming move into the upside. Now, currently it's sitting at 6.48 into the green with the yield sitting at 3.362. Now, that is significantly higher than the quarter, 3.25, that a lot of people were thinking. And for me, I was calling possibly as high as 350. Now, to see it move with that level of aggressive uncontrolled movements is actually quite alarming. And if we do see another situation trading day tomorrow where we're seeing uncontrolled gains of 3, 4, 5, 6, 8% to the upside, which isn't out of the realm of possibility, especially considering traders are factoring in a possibility of a 0.75% increase by the Fed on Wednesday, even though Powell has already come out and said 50 basis points is what they're looking at for the next few sessions. There's still that uncertainty out there that is causing a lot of very negative sentiment on top of the fear of recession, which the truth of the matter is inflation shouldn't be an issue. Recession shouldn't be an issue in terms of fear because we have already known about these variables and the reality of them coming to light for quite some time. But let's continue on with the 10-year yield and what it could mean. So for a long time, I've been saying watch a 10-year yield because if we see multiple uncontrolled movements to the upside where we're seeing high levels of percentage increases, so 3%, 4%, 2% even, it could be an indicator that there's going to be an implosion in the debt market. And if there is that implosion in the debt market and this massive sell-off in bonds and a move to dollars, you can expect that the equities market is going to follow suit, which is exactly what we saw today. The problem is, if it's truly the beginning of the end, and we do see another day or 2 days that could really cause me to raise the red flag, then you can anticipate that the markets, as I've talked about before, could possibly pull back from this point another 50%. Very possibly. Because the truth of the matter is we don't actually know what the bottom is. The markets have been artificially inflated for a very long time. So we don't know what the bottom is. We've seen some aggressive moves to the downside back in 2020. We've seen it in 2008. But we really don't have an idea what the downside is. And so we're really not sure. And because of that, I wouldn't be surprised if we saw a 50% decline in the market from where we are now. I know there are people out there that are saying as high as 60% from the market highs. Again, it's not outside the realm of possibility. So it's very important, I think, at this point that you absolutely consider preparing your portfolio for a defensive position. And that could mean anything. For myself, it's a significant move into commodities and a very significant move into precious metals, even though gold and silver fell under pressure today, quite significantly, actually. I am still very bullish, as the nature of the cycle tends to be a lagger rather than a leader. I think that having opposite strategies to possibly equities may be a good position. So for myself, for example, I do have put positions set out against my existing equity holdings, just to make sure I have some kind of quote unquote insurance policy against any kind of aggressive downside movement. Now, a lot of this really depends as well on what the Fed does on Wednesday. Again, if we see a 50 basis point increase, then I think the markets will probably recover, bounce to the upside, and again, get out of this bear territory. Not necessarily saying we're going to see record highs or anything of that nature, but we will certainly see a move to the upside, because that is what has caused much of the fear in the current market condition. If we get a 75 basis point increase, I wouldn't be surprised to see the markets react very quickly down to the downside, within a few trading sessions, down 10 to 15%. Now, granted, that would be factored in, and it's probably what's being factored into the 10-year yield right now. But we'll see what happens on Wednesday, because if we do get 50 basis points and the market doesn't react quite the way I think it should, then that's just further confirmation that the markets are ready to pull further down, and probably quite significantly. But for now, we are monitoring, we are preparing positions and preparing portfolios to ensure that we are getting ready for a defensive position. And that could absolutely mean getting into a position of cash, short-term interest rates, daily interest type investment holdings, money markets, anything that can be transitioned back into the market very easily and transitioned out of the market very easily. There's nothing wrong with that. Or like I said, if you are a little bit more savvy or you manage your own accounts, then perhaps getting into different types of options positions or whatever you like. That's totally up to you and what's appropriate for your portfolio. Make sure that you understand the risks and dynamics of your portfolio and why you're doing something within it and how you can offset your positions. I know for myself, I do have cash positions, but that's really to take advantage of any downfall in the market, to be prepared to buy back in. But otherwise, as I mentioned, I myself am looking at commodities, and I'm looking very specifically at crude, energy, and some agriculture, which I've talked about many, many, many times here on the channel. But that's it. I think for now, we're just going to monitor, see what happens tomorrow. Hopefully, we do not see another run up in the debt market. If we do, it really could be a big signal here. But that's it, everybody. I will see you tomorrow morning at the opening bell.